Hello everybody. I'm a bit like Theo in that we were hoping to have someone here from our Department of Business Innovation and Skills to present this today, but unfortunately our UK government timed the budget to coincide with this DIFASS workshop, and they all had to stay in London because the government announced our new austerity budget yesterday, which didn't amount to very much actually by the look of it, but so they couldn't come, so I'm going to present this. For a change, it is something that I do know about. I used to work as a business advisor until a couple of years ago and used to help businesses apply for these sorts of guarantees. So it is sort of a subject that I've worked with. Apologies for the volume of information on the slides. On some of the slides there's a lot of detail. I decided to leave it because it'll give you that information after the event. I'm not going to read through it all and go through it all. I'll try to summarise and give you a feel for how it's delivered and some of the problems that we have with the programme. It's a national programme, Enterprise Finance Guarantee Scheme. It was introduced in 2009 to replace a previous scheme that was very similar but wasn't working very well. Businesses had lost confidence with the banks, and it was a complex scheme to actually get through the process and to receive the guarantee. So it was replaced in 2009 with the Enterprise Finance Guarantee Scheme. It's part of the sort of general government's programme to try and increase the flow of credit to UK SMEs. It's about debt rather than equity, so we have other programmes that have to do with equity, but this particular programme is all around debt. It's for businesses, aimed really at businesses who don't have security for the loan. One of the key differences between this scheme and our previous scheme is that banks aren't allowed to include the residence of the business owner, the private residence of the business owner in security. So banks can take some security, but they aren't allowed to take the private residence as security. But this is more for businesses who have very little security in terms of assets or property. And specifically really aimed at the sort of younger startup type businesses who obviously don't have that sort of asset base. It's delivered by the banks, so the government backed the scheme, but it's delivered by the banks, and applications are made to the banks and decisions are made by the banks on a commercial basis. And that's really where the first weakness is, because the banks apply their standard credit ratings, their standard credit scoring process to the decisions. So there's no change in their systems for this scheme. I'll talk a little bit more about that later. The government guarantees 75% of the loan. The bank therefore has 25% of the loan left as sort of them guaranteeing that. But the government only guarantees 75% of the loan up to what they call a cap. So with each bank that delivers this programme, the government says, okay, we'll guarantee the loans that you give, but we'll cap the level of support we will pay you at a certain level. And if loans default and it goes above that cap, then the banks have to pay that as well. So it's not fully guaranteed by the government. It's only guaranteed up to a certain limit. So again, the banks are going to be perhaps a little bit more cautious because it's not really what it says. It isn't a full 75% guarantee. So that's a sort of a second weakness really with the system. And the borrower, the business, pays 2% over the standard bank interest rate for that type of loan. So comparing it with some of the examples we've had earlier today, that's quite a high percentage above. I think someone mentioned 0.5% or 1%. Eligibility. Basically, eligibility, I won't go through this, eligibility is in line with state aid rules, the normal standard rules. Loans are for between £1,000 and £1 million, so a broad range of size of loan, and for a period of 3 months to 10 years. So quite a broad range of loan length there. Certain sectors are excluded, primarily sort of education, transport, agriculture is excluded as well, which again I think in some of the other examples agriculture was included. In terms of what people can get guarantees for these loans for, it's mainly new loans or refinancing current loans that are at a higher interest rate or need refinancing, for working capital or for investment purposes. For conversion of overdrafts into loans, if working capital is getting tight, a business can apply to convert some of its overdraft into a loan, so it frees up its overdraft again. And for invoice finance guarantees. Having said that, that's a very small proportion of the guarantees that are given. Most of the guarantees are for working capital, so over 30% of the guarantees are given for working capital. About 12% for asset-based loans, about 12% for startups. And invoice finance is only about 2 or 3%. In terms of the application process, as I said before, businesses approach the banks directly, so they follow the particular bank system for applying for a normal commercial loan. There are 43 different lenders at the moment that are approved through the system, and they range from the large banks right through to more regional organisations and 1 or 2 smaller localised organisations, but there are 43 in total. Having said that, what we call the Big Four banks, which are the Royal Bank of Scotland, Lloyds, TSB, HSBC and Barclays, account for more than 90% of the guarantees that are given. So it's the Big Four banks really that allocate the bulk of these loans. In fact, the 2 biggest banks in terms of percentage who give 60% of the loans, or more than 60% of the loans, are the Royal Bank of Scotland and Lloyds TSB. And those are the 2 banks that were effectively nationalised when the crash occurred. So it's sort of an indication that perhaps the government is putting pressure onto those particular banks to actually guarantee the loans, whereas the banks that aren't so tied to the state system aren't as interested in giving these loans. So the businesses have to go through the bank's normal process, and then when they get to a point at which the bank says, yes, we would lend you this money, but actually you haven't got the assets to guarantee it, that's when this process can be applied for. One of the criticisms of it in the past has been that it's taken too long. So I noticed your 24-hour example with the Express, the BMV Express. There's been a study done that showed that it was 60% of the loans were taking more than a month to be processed. And of course, again, that has a serious effect on businesses if they've got working capital issues, anything like that. So one of the issues with the process is that it takes quite a long time. It takes very slow. They have introduced some new legislation to limit that to 20 days, but we don't know yet whether that's working or not. But there is a sort of moves in place to try and reduce that. In terms of what businesses pay, as I said, businesses pay the banks the normal standard interest rate that they would charge for that commercial loan, plus 2% for the guarantee. That guarantee, that 2% goes into a central fund that the government then obviously uses to offset defaults. The average interest rate, again, a recent study was done, the average interest rate for the smaller loans, for the loans £1,000 to £25,000, and that tends to be for the smaller businesses, was 8.1%. So actually those smaller businesses are paying 8.1% to the bank and then 2% for the guarantee, so that's relatively high. In terms of statistics, sort of what's happened over the last 4 years now, there's lots of data on this, so I can sort of I'll provide you links to some of this data if you're interested. But since January 2009, there have been 20,000 loans offered, which is just over £2 billion worth of loans offered. 17,500 loans have been drawn down, so 2,500 were offered. Who knows where they went? The other issue with some of this data is we don't know how many people started the process. We only know how many loans were actually offered, so we don't know how many businesses didn't get to that point. But 2,500 people didn't draw down the loans. So there's been 1.8 billion worth of loans guarantees given since this commenced in 2009. But that's less than 2% of the SME commercial loan marketplace, so it's a very small proportion of the total SME commercial loan marketplace in the UK. Another weakness, as I said, is the fact that we don't know how many were put off from applying for this. There's been a 28% default rate in the loans that commenced in 2009, which is lower than the default rate with the old scheme, but higher than the standard commercial loan default rate. The average size of a loan is about £100,000. 70% of them are between £1 and £100,000, so they tend to be towards that lower level. And that sort of data suggests that it is getting perhaps to the target market of the smaller end of the SME marketplace. Lots of statistics here. These statistics are from a recent study that was published in February, which went back to the first cohort of loans from 2009. So it's looked at those businesses that took out loans in 2009. It's looked at them at the end of 2012 to see what effect the loan had on their business. This was partially done because in yesterday's budget, the government announced that they are putting more money into this scheme, so they were obviously looking at the evaluation to see whether the scheme actually was working or not. A summary of that, in that first year of operation, jobs created by the businesses who had the loan guarantees were 6,500, jobs saved 12,400. Net exports increased for those businesses by £460 million, and net sales increased by £1,344 million, so a very positive effect on those businesses. The net cost that they calculated for the scheme in 2009 was £178 million. And that includes the costs of the default, the 28% default rate, and the costs of running the scheme, sort of everything included. So the evaluation concluded that it's a worthwhile scheme, that it does add to the sort of net economic impact on the country. That's sort of a lot of data. Hopefully that's given you a picture of it. Lots of information there, and any questions?
Thanks, Jackie. Are there any questions? Were there any questions? Yes.
Hi, all. I'm Vasilis Ragias from Greece. I'd like to ask a question regarding the presentation you made. It just didn't seem as if it's really good practice. I mean, all these figures turned out to be rather more negative than positively expected. The figures are not the expected ones. I would like to ask what could be done towards improving the SMEs financing, since the rate of default, as you said, rises up to 28%, which is something really bad for financing a financing institution, whether it's a private owned bank or a state owned one.
Well, as I said, actually, that's 28% default rate versus the prior scheme is viewed as an improvement. So they are working on the scheme and looking at making modifications to it. I think one of the issues is that it's perhaps, I mean, we've presented it as a good practice, but perhaps it's, compared to some of the others, perhaps it's less flexible because of the way it's delivered. An example is that about 2 months ago, an SME who applied for this through the scheme didn't get approved and wrote to the Governor of the Bank of England explaining that they hadn't been approved, complaining, asking why. And the Governor of the Bank of England replied that perhaps they ought to go and talk to, I think, is it the Handelsbank, the Swedish bank, Handelsbank, who are setting up a lot of branches at the moment in the UK. They're expanding rapidly in the UK, and they're setting up a more localised banking system, whereas ours is very much a national system. And so the Governor of the Bank of England, who effectively runs this scheme, actually advised a business to go to Handelsbank because they may get an approach from that bank that is more localised, that looks at their situation in the region, in their area. So I think there are lessons to be learned from perhaps our scheme. This is my opinion. Perhaps our scheme is too centralised, and maybe that's why we get a higher default rate, is because the people who are actually looking at the applications don't understand the local or the regional environment. That's my opinion, no, not
Yeah, it seems, however, that due to that crisis period we're in, the lending procedures are deteriorating for SMEs. I'm asking how can this improve? I mean, are there any ideas besides decentralizing the whole system? Because given it a central dimension, does not significantly improve centrally the lending conditions, but decentralizing it, like going to foreign banks, for instance, do you think that would be a solution? Or you might turn to other schemes such as guarantee funds or other financing institutions besides banking systems?
I mean, that's I think is a key. I went to an event on Tuesday this week where an organisation were talking about crowdsourcing for invoice guarantees, and that seems to be one of the sort of interesting new ideas really for SME finance. And I think that's off the point of this seminar, but that's something perhaps that will be interesting for us all to look at, is the rise of crowdfunding and crowdsourcing, because that to me seems one of the major sort of opportunities for SMEs. I don't think that answers your question really, but
That's what my initial thought was, that I mentioned to you.
It's more of a comment than a question, but it's just to share the same kind of opinion you expressed about the fact that sometimes it's too much centralized. The invasion, in our case, the two possibilities are available. So there is the national banks and the national guarantee scheme, as discussed before, and the local bank. The local bank is traditionally an agriculture bank, and it's owned by local stakeholders, so it's a kind of cooperative bank. And the national bank, or applying to the national bank, local companies are competing with very high profit, very large projects like private partnership and so on. So there is not an issue about guarantee, but there is an issue about profitability or the competition against some other big projects that are absorbing the financial capability of those banks. The local bank is less exposed to that competition. It's more open for the local loans and actual companies because the funds are kept available as they are not so able to go to the big national projects. So I think it's really it might be really an issue about organizing these kind of mechanisms is to keep local the financial support and also the project the assessment of the project capability to assess the funding. So it's just a comment.
I would agree with that. I think another thing another event I went to, I think last week, was talking about localising the banks in the UK and perhaps moving more towards the credit union model as well, than having local credit unions. So I think that there could be a move in the UK anyway towards that.
I agree with you. The point, there are 2 points, I think. One is in practice, which could be the best system. Either we have a regional guarantee scheme, or we have a national one. I think it seems obvious that since we have a regional guarantee scheme, the medial guarantee company can have a better access on the company that asks for a guarantee. Further, this company, the SMS, since works in the region, everyone knows everyone in this region. So maybe further of figures, those who are going to take the decision to give the guarantee knows directly the person who owns the SME. So there is a physical, direct relation, which is not the case when we go to a national guarantee scheme. But On the other hand, there is another problem, which is the source problem. Since in the regional guarantee scheme, we have, let's say, limited sources, which cannot be the case, of a national guarantee scheme, especially when the state and the European Union finances this. So we have some points that favorize the mutual guarantee scheme, especially on the personal contact and the better knowing of the SME. On the other hand, is the question always of the sources that have been behind the guarantee scheme that is going to help the SME that ask for a guarantee.